Welcome back, folks. This is teaching number 7 of 8 for the month of November 2016 in the ICT mentorship. We're going to be teaching trendline phantoms or false trend lines. And the first is going to be diagonal trendline support. The priming is done by way of seeing the market begin to make higher highs and higher lows. The market appears to have an imaginary diagonal line it seems to repel price higher from. Retail traders will extend these imaginary lines into the future and attribute support theories to it. When price hits the extended imaginary diagonal line connecting higher lows, retail traders buy it then. Conversely, diagonal trendline resistance. This is primed in the thought processes of retail traders by seeing the market begin to make lower highs and lower lows. The market appears to have an imaginary diagonal line it seems to propel price lower from. Retail traders will extend these imaginary lines into the future and attribute resistance theories to them. When price hits the extended imaginary diagonal line connecting lower highs, retail traders short at that moment. Okay, trendline theory. Now, it's my perspective that there's no basis on trendline theory in the form of diagonal support or diagonal resistance. And I believe it's just basically an opinion. There's no statistical edge that I've been able to build with use of diagonal support or resistance in the form of trend lines. Now, I've been doing this for 24 years coming up, and just about the end of the month we're actually producing this video in, I will have been a trader for 24 years. And in 24 years, I've done a lot of things in analysis. And I was indoctrinated with trend lines when I first started. And to me, it made perfect sense because I could see it in the past. And all the books give us perfect examples where it all works. But when we try to use the trend line idea, which lows do you draw connections to? Which highs do you draw connections to? And quickly, all of a sudden, it's like, oh, well, maybe this isn't as easy as I thought it was. But does price have an awareness of the point of trendline support? Or does price have an awareness of the point of trendline resistance? I'll submit to you that it does not. Price has no awareness of your trend line. Price doesn't respect what you have on your charts. Price only respects where the actual liquidity is in the marketplace. And because they can't see you because you're too small, the marketplace sees where the large pools of liquidity are. That means in buying interest and selling interest that's already in the marketplace in the form of protective sell stops, protective buy stops, or new buy stops for long entries or new sell stops for selling entries. That's the only thing that makes price move. And it's going to be hinged and framed on the context of who is in play right now. What smart money entity has the control of the marketplace at the moment? Is it going higher based on their book being bullish, or is it going lower based on their book being bearish? And that's what this mentorship teaches. It gives you those ideas to go into seeing where price is most likely going to go. And we don't subscribe to down-sloping trend lines or up-sloping trend lines to formulate ideas in which we find support or resistance based on that idea. Do banks associate value or prognostication on the basis of trendline theory? I'll submit to you, no, they do not. Now, for some that are in the financial industry, maybe you're working at a bank, maybe you have used them in the past and you've had success. I'm telling you, the banks don't have any association or prognostication placed on valuing a trend line level on a diagonal basis. And the reason why is because it's so subjective. You are associating future price movement to a level that hasn't been traded to yet. You're doing it on the basis of connecting two reference points in the past that don't have any bearing on what the future price is going to do. It has nothing. That high that you connected to a lower high when you're looking for resistance or downtrending trend line resistance, that third time it supposedly comes up to that line what makes you so confident that it's going to go down at that point? Just because you drew the line on your chart? The banks don't care what you're scribbling all over your charts. They don't care about that. They're not aware of it, okay? But what they are aware of is sentiment that shifts and builds around those levels, because it's going to be many times being replicated on the fund level. Funds will get beat up. That's the basis of trading. Large traders are the prey. That's where the markets go. They go for their orders, not for our little orders, not for our little liquidity, okay? But because we learned to trade and herd like the fund traders, we are many times are casualties of that war between smart money and large funds. That's the business model that goes on. Large funds are cannibalized at reversals, but they're permitted to facilitate long-term trends when the markets are in that environment. But trend lines are not the key to it. Is the very nature of trend lines flawed at its core? I will submit to you that yes, it is. Because it gives too many dangling carrots in front of the trader's eyes, thinking that, okay, this is going to be an easy setup, so therefore let me go in here and sell at this resistance trend line, or let me buy at this diagonal support trend line. It's not that easy, folks. But many times our charts will paint these beautifully disguised opportunities that are impossibilities. Knowing this, how can market makers capitalize on this fallacy in price action? Retail bullish trendline support. In periods when price is making higher lows and higher highs, the use of trendline support will be adopted by retail traders. The influx of weak-handed or less informed money at an area or price level provides liquidity for the market maker. The chart may appear bullish, but the underpinnings are in fact the opposite. The retail crowd will buy at a moment when price will be devoid of support. Price will collapse and leave the retail trader long with drawdown in the trade. When that third touch of that uptrend line is seen in price action, many times I get dialed in expecting the high that forms between the low at the second time it hits the trend line and the third time it hits the trend line, that high in between, I aim in that high for a bearish order block, or I will be allowing price to just briefly poke its head above that high for a turtle soup. Especially if the higher time frame charts that I use for my analysis indicate that we are not in a bullish environment, but the lower time frames will many times paint these beautifully illustrated uptrend diagonal support lines. So what I'm trying to do is I'm focusing in on when the market maker sets their traps for a sell scenario. Many times that high in between the low that forms at the second retouch of that trend line and the third touch of that trend line, the high in between, there is going to be a sell scenario that I'm aiming for in that. I'm looking for a bearish order block, or I'm looking for maybe sometimes on a lower time frame, I'm looking for a breaker, a bearish breaker, where the market has shown a willingness to rally up to take out an old high that's on a lower time frame that may not be seen as clear with that high in between point number 2 and point number 3. All I'm looking for is a reason to be contrarian, because if the trend line looks so obvious, to me, I look at that as a trap. Retail bearish trendline resistance. In periods when price is making lower lows and lower highs, the use of trendline resistance will be adopted by retail traders. The influx of weak-handed or less informed money at an area or price level provides liquidity for the market maker. The chart may appear bearish, but the underpinnings are in fact the opposite. The retail crowd will sell at a moment when the price will be devoid of resistance. Price will rally and leave the retail trader short with drawdown in the trade. Between the high formed at point number 2 and point number 3, the low in between those 2 points, I'm going to be aiming for a reason to be a buyer down there. Because I will submit to you that if the higher time frames are indicating that the higher price is most likely going to be in the near term, and we're trading at higher time frame support levels based on order blocks or institutional order flow, I'm looking for that low between high 2 and high 3. I'm looking for a bullish order block at that low in between the 2 points. And while price may drop down into that old low just by a little bit, but not get down to that low altogether, I will be looking for a bullish order block to buy. Or I will accept a break just below that low for a turtle soup long entry, or basically a run on the sell stops. Many times the market will break through. Now, a point at which I want to draw attention to is the second point at which you have that trend line. In other words, that the first high you see, and then it comes down and makes a lower high at number 2, and it trades lower, and you think it's going back up to make a number 3 point high that's lower, or 3 times touching on that downtrend. When the market rallies, I'm actually going to be looking for a move up into that second high, because that's where a lot of the buy stops are going to be residing. The same thing said, just an opposite, when we're looking for that sell scenario in bullish trendline support. Retail is going to be looking for it to go higher. I'm looking for it to go down below point number 2. That's where everyone's stop loss is going to be. Now, when you think about it like this, trend lines in the form of diagonal basis, support or resistance, it's really a toss-up. Do you have confidence that the trend line that you're drawing is going to really provide support or resistance? Think about it. It's really associated closely to flipping a coin. Heads, you're going to be a buyer, and guess what? Tails, you'd be a seller. You're back to the same equation of chance, and we do not trade with the perspective of chance. When we trade, we look at the marketplace to provide clues in which the smart money is going to be utilizing the liquidity that's made available for willing or unwilling liquidity in the form of the funds and uninformed money. You have to think like that liquidity provider. Price is delivered to engineer efficiency for the smart money entities only. Okay, folks, let's take a look at examples here. Okay, I want you to take a look at this high right here. Okay, price has a nice run away from that. So we have a very nice intermediate term high with an impulse price swing moving lower. And we have a gap in here, fair value gap from the low of this candle to the high of this candle. There's only been down movement with this candle's body. And we're going to highlight this whole area in here. And we're going to reference the low of that candle right here. Okay, so we're going to watch price as it trades. That's just a reactionary level that we're going to be waiting for in the future. So this is how we stalk a setup. Price starts to rally up. Trades right into that 52.34 level right there. That day it occurs is December 11th, 2015. Okay, over here on the right-hand side, we have the 15-minute time frame for December 11, 2015. And we're going to delineate that same high at 52.34. You can see price hitting it right here. And I want you to look at how this low connected to this low here, projected out, eventually has another third time hitting it. Okay, so trendline followers would see that as a potential continuation to go higher, finding some support here, 1, 2, 3, maybe a run up higher. Problem is we have a daily institutional reference point over here, and we're in that area over here. In this whole shaded area, we've closed that in. So we would be looking for the next area of liquidity in down here. So we could look at this range from this down candle's high up to this down candle's low. between this candle's high and this candle's low, it's only been one pass on the upside. So we're going to be looking for price to want to come back down into this candle's high in the form of 50, 60. Okay, so 150, 60 level. So we know that there's a possibility to see price want to drop lower based on liquidity. We have trend lines in here that would be reasonable in terms of what retail would be drawing, expecting some bullish prices. Let me show you to you what it may look like at the time when it was forming. Okay, you have a low here. They're finding some support here, old high back here. So they could reasonably expect to see this to trade higher. Problem is the only thing it's done is move back up into the last up candle here, which is a bearish order block right there. So using the market efficiency paradigm, we don't see this as trend line support. We see this as a return up into a reason to get short more and the market breaks lower. Market trades down into a low right here, which we'll look at when we zoom out in a couple minutes. But we have a low here. We have another low here, projecting that low out in time. Okay, we can see price coming down to that third time. Does it make a bullish scenario? No, it's only going up to the last up candles, midway point, or mean threshold. So let's take a look at what that is. Okay, right in here, equilibrium, trading right at that reference point. We're going to be looking for price to come down and close in this void. This candle's low here, and this candle's high. So in here has a liquidity void, and we have sell stops below this low here. Again, remembering that we're focusing on the idea on the daily chart, like a bank would, looking for 150, 60 level. So up here, we're looking at this market move higher. Anything that would be viewed as support on diagonal basis on a trend line, we're going to look at that as suspect. And buyers are going to come in here in a big influx. We're going to have wonderful opportunities to be sellers to them. Market trades up into the equilibrium. One more time, pierces the high, turtle soup. Sells off, and it trades one more time down into this level in here. So I'm going to zoom out a little bit to a 30-minute chart. You can see that other trend line. So we have a low here, extend it out in time. Here's another low, and price comes down, hits it here. Is that a buy? No, it's only coming back up into this last up candle, bearish order block, sell here. Do not see this as a bullish scenario because of trend lines, because we're expecting this area here to promote selling. Okay, it's in an area in which we're going to be looking for a sell-off. Price does in fact sell off, and you see the bearishness here. It runs back above old high, turtle soup, or bearish order block. Okay, because we're using a higher time frame setup over here, your stop would provide you an opportunity to put a stop above an old high back here. Price accelerates, goes through what would be considered trendline support, and ultimately down into the 150, 60 level right here. And as you can see it over here. So let's take a look at some downtrending or bearish trend lines that are actually buy scenarios. Okay, folks, we have a nice run up here. Two down candles right before the up move. Okay, so we have 143.85 or thereabouts. The opening price on here is 143.84, so we'll round it to 43.85. Okay, and we have a down candle. It hits 43.85. So we're going to add 43.85 to our lower time frame chart. So 43.85, we see price trading down into it here, hitting it one more time. We have a high, we have a lower high, and the third time price hits it here. Do we see this as a sell? No, we don't. We see it as a potential turtle soup long here, or a return back to bullish order block. So we could be a buyer at 43.85 or 43.90 on a limit, or if we can get a fill at 43.80 or lower, you can be a buyer down there with the expectation that this is a false trend line, and we would be looking for this high in here. That's the second one. So anyone would be short, all their protected buy stops will be above this high in here. Price rallies away. Comes up real close to this high in here. One more retracement lower. Back down into the last two down candles here as a buying opportunity. Again, up here is where we'd be expecting to see the buy stops be tagged. You can see that happening here. Buy stops hit right there. You can see that happening here. Buy stops hit right here. Then you'd be permitted to see lower prices because we've seen the highs taken out here for the form of a buy stop raid, and then now the liquidity below here would be allowed to be tested. And you see that happening there. Here's another example. We have a nice down candle here, bullish order block. It's validated when this candle trades above this down candle's high. The very next candle we trade up again. In the third candle, we see it opens here and trades down into the body of this down candle. The mean threshold is approximately 144 big figure, and the open comes in at 144.46 on this down candle. So we have 46 pip range in here. And the day on this candle is the 18th of May of 2016. We see the 18th of May here, okay, and we see the high, a lower high, can extend that out in time. Does price sell off here? A little bit, but then it comes up, pops through one more time. So traders that even see this as a downtrend that maybe have been broken, they may see this as a return back down into it to be a buyer, and they're wrong there as well. Also, you may see a classic chart pattern here that we haven't spoke about, but we're going to talk about it in this mentorship as well. Classic chart pattern, triangle, and false breakout here. They would have been wrong even trading with that, and then exploding up into the 146 big figure. Now the reason why 146 big figure is it's the last up candle in the daily chart, and it closed in all these down candles, so institutional order flow is going to see price come up and close all that in. So it's only been delivered on the downside, all down candles. Price has to be efficiently balanced by offering on the buy side. After it's been sold off and been offered on the sell side, price to be efficiently delivered has to be offered on the buy side. So we see that rally back up into that 146 big figure, and that's why it quickly ran up into that level here. But breaking this idea of these supposed trend lines, that's not the key to it, guys. But we can see when the trades are seeing these retail fingerprints all over it, probabilities really shift in our favor when we're doing the opposite of it. And we can also justify it with institutional order flow and institutional reference points on the daily chart, just like a bank would. So hopefully you enjoyed this teaching. Go back through all your charts, look at some of the moves that's taken place, and go down to lower time frames, and you actually see how these trend lines are really there as phantoms, and retail chases them. And when they think they see them, they're really not there, and they end up giving out the ghost and their profits.